It was a morning like any other. Charts open, coffee in hand, indicators blinking in rhythm with the market's heartbeat. But inside, something felt off. I had a plan that day, a simple one, but as soon as I entered my first trade, that plan started to feel optional. The stop loss I had so carefully calculated, I didn't trust it. My mind raced. Maybe it'll turn around. Maybe this dip isn't real. Maybe I'm missing a bigger move. Those three little words, maybe, became the siren song that led me straight into one of the harshest lessons of my trading life. The stop loss is a concept every trader knows in theory but few truly respect in practice. It's more than just a number on the chart. It's a psychological tool, a boundary that defines your tolerance for risk. It's what separates calculated risk from reckless gambling. And yet, in that moment, I found myself questioning its authority. Why? Because fear and greed are cunning companions. Fear whispered, "You'll miss your chance if you exit now," while greed chimed in with, "If it bounces back, you'll regret leaving too early." Between them, I was paralyzed. The first lesson I learned that day wasn't about the market, it was about me. Most traders fail not because of poor setups, flawed indicators, or unlucky markets. They fail because of the tiny, almost invisible choices they make in the heat of the moment. Choices shaped by emotion, habit, and belief. Breaking a stop loss seems harmless at first. It's just a small trade, you tell yourself. But small trades compound, and emotions escalate faster than equity curves. I watched the trade swing against me. At first, it was a small loss, nothing to write home about. Yet with every tick below my stop loss, panic and frustration grew. My heart raced. My breathing shortened. Thoughts spiraled. I should have exited. I knew this could happen. Maybe I'm not cut out for this. And in that spiraling state, I did the one thing that nearly destroyed my account. I moved my stop loss further away, rationalizing it as giving the trade more room to breathe. Here's the dangerous truth. When you start rationalizing breaking your own rules, the market doesn't change. You do. And you do so in ways that compound mistakes. A small loss morphs into a medium loss, and a medium loss can explode into something catastrophic if unchecked. It's like ignoring the check engine light in your car. You think, it's fine. Just a little longer. And suddenly you're stranded on the side of the road with a bill you never saw coming. I want you to imagine this not just in trading but in life. How often do we ignore boundaries? How often do we overextend ourselves, convinced we can manage the consequences later? In trading, the stop loss is the boundary. In life, it might be the limits you set for your time, energy, or patience. Breaking those boundaries feels tempting in the moment, but consequences are inevitable. The lesson is painfully clear. Respecting limits, whether in trading or life, is the foundation for sustainable success. By the time I finally exited that trade, the loss was twice what I had risked initially. And yet, more than the financial pain, the psychological toll was staggering. I felt foolish, frustrated, and deeply aware of my lack of discipline. But here's the paradox. That low point became fertile ground for transformation. Pain has a way of teaching lessons that comfort never could. It forces introspection, forcing us to ask uncomfortable questions. Why did I break my rule? What emotions were controlling me? What can I change to prevent this from happening again? One of the first realizations was simple yet profound. Discipline isn't about following rules when it's easy. Discipline is about following rules when your mind is screaming at you to do otherwise. Every successful trader you admire didn't become skilled because they never faced fear, greed, or doubt. They became skilled because they learned to act in spite of it. In that moment of breaking my stop loss, I began to understand the invisible line that separates amateur traders from professionals: awareness of self. Real-time awareness, I realized, is everything. Most of us process losses after they happen, reflecting on mistakes in hindsight. But in trading, waiting until hindsight to analyze emotion is too late. The battle is fought in the now, every second, as the market ticks. The moment you feel fear creeping in, the split second your impulses urge you to override your plan, that's the decisive moment. Recognizing it in real time is what turns a mistake into a lesson instead of a catastrophe. So, how do we cultivate this awareness? It starts with paying attention to your emotional state at all times. Small habits make a big difference. Taking note of your physical responses, tension in your shoulders, shallow breathing, racing thoughts. Asking yourself, am I acting from clarity or reaction? Developing a habit of mental pauses before executing decisions can interrupt destructive impulses. These micro pauses might seem insignificant, but over time, they compound into a structural advantage over your own emotional biases. Another key insight from that painful day was the realization that our beliefs about trading shape our behavior more than any technical indicator ever could. I had unconsciously developed the belief that a loss reflected personal failure. I tied my self-worth to the outcome of trades, not the process. This belief made the stop-loss feel like an enemy rather than a protective mechanism. Rewiring this belief was critical. Losses aren't punishments, they are information. They are data points that refine your edge. Accepting this mentally transforms the stop-loss from an obstacle into a shield, protecting capital and confidence alike. In the end, the day taught me that rules exist for a reason. They are there to safeguard you from the very human tendencies that sabotage progress: impatience, ego, fear, and greed. But rules alone aren't enough. You need the mental infrastructure to follow them consistently. That infrastructure is built through awareness, reflection, and intentional practice. The stop loss isn't just a number, it's a test of your mental fitness, your ability to adhere to principles under pressure, and your commitment to long-term success. And so, that day became the turning point. Not because I avoided a loss I didn't, but because I began to see the patterns within myself. I started to notice the triggers, the emotional cues, the moments where rational thought is overridden by instinct. I realized that trading success doesn't come from clever strategies or perfect indicators. It comes from mastering yourself, from building the discipline to honor your rules, even when the market tempts you to abandon them. From that experience, I began a deliberate practice. Before each trade, I would check in with my emotional state. During trades, I would monitor impulses and reactions. After trades, I would journal outcomes, not just financially but psychologically. These practices transformed trading from a reactive, stressful activity into a disciplined, self-aware process. And the first step of that transformation, the hard step, was painfully simple. I had to respect my stop-loss, no matter what. After that brutal experience, I realized that merely knowing the stop-loss exists wasn't enough. I needed to understand why I wanted to break it. The answer was always fear, subtly disguised as hope or rationalization. Fear that I'd miss out on potential profits, fear that I'd appear incompetent to myself, fear of accepting that I was wrong. And the ironic truth? The market didn't care. The charts didn't care. Every tick, every candle, every spike was indifferent to my fear. But I did care, and because I cared, my mind found ways to sabotage even the most logical decisions. I began studying my emotional triggers. Each time I felt the urge to override a rule, I would pause and reflect. Why am I doing this? What am I trying to avoid feeling? Often the answer was simple. I was trying to avoid discomfort. I was trying to protect my ego from a temporary setback. I was attempting to control something that, by its very nature, cannot be controlled: the market. That realization was humbling but liberating. To counteract these impulses, I built mental checkpoints. Before every trade, I would silently reaffirm my plan: the entry, the target, the stop loss. During trades, I would monitor my physiological responses: the tightening of my chest, shallow breathing, or racing thoughts. Recognizing these signs became my early warning system. It wasn't about suppressing emotion, it was about noticing it before it dictated my actions. By labeling the emotion fear, greed, impatience, I gained a fraction of space, enough to act with intention rather than reaction. I also learned the power of reframing losses. Instead of seeing a stop-loss hit as failure, I began to view it as feedback. This trade taught me something. It confirmed the limits of my edge today. It preserved capital for future opportunities. This subtle mental shift changed everything. Suddenly, following the stop-loss wasn't a concession, it was a strategic choice. It was the act of winning in a different dimension, the mental and emotional dimension. Pattern recognition became the next crucial step. I started journaling every trade, not just the numbers but my thought process and emotional state. What prompted me to enter? What impulses did I feel? Did I respect my rules or bypass them? Over weeks, patterns emerged. I noticed that certain market conditions made my impulses stronger, certain setups triggered overconfidence, and some times of day amplified stress responses. By identifying these patterns, I could preemptively prepare for them. I could enter trades with a heightened awareness, knowing the exact moments my mind would try to derail me. One realization was especially stark: most mistakes weren't about the trade itself, they were about the chain of thoughts that led to it. I would justify exceptions to my rules with seemingly logical reasoning. It's just this once. The market is behaving differently. Yet the market never behaves differently, it simply is. Our job as traders is not to convince the market to act as we wish, but to adapt ourselves to the market's reality. Every deviation from the plan was a lesson in humility. Each one highlighted the gap between knowledge and action, between theory and practice. I also experimented with micro-rituals to reinforce discipline. Simple acts like standing up, taking 3 deep breaths, or briefly stepping away from the screen when emotions spiked became surprisingly effective. They interrupted automatic reactions. They bought a few critical seconds to regain composure and perspective. Over time, these small habits transformed from conscious interventions into automatic behaviors. My body and mind began to instinctively respect the boundaries I had set. There was another layer I had overlooked initially: accountability. Trading in isolation amplifies self-deception. Without someone or something to hold me accountable, rationalizations slipped in effortlessly. To counter this, I documented every trade in a shared log, not to impress anyone but to create a mirror. Seeing my decisions and their outcomes objectively helped me confront patterns I couldn't see in real time. I began treating my journal not as a record of profit or loss but as a tool for emotional calibration. Through this process, I discovered the subtle difference between patience and passivity. Waiting for the stop loss to execute doesn't mean you're doing nothing. It's active patience. It's engaging your mind, observing the market, evaluating conditions, and letting your strategy do its work without interference. Most traders confuse patience with hesitation or fear. True patience is informed, disciplined, and deliberate. And learning that distinction reshaped my approach to every trade I took thereafter. As these lessons compounded, the nature of my trading transformed. I no longer feared losses in the same way because I understood that each stop loss executed correctly was a victory of discipline. The real account growth happened internally. I became more consistent, less reactive, and more confident not because I had mastered the market, but because I had begun mastering myself. The stop loss, once a symbol of constraint, became a cornerstone of control. Even beyond trading, these lessons spilled into life. Boundaries, discipline, and emotional awareness became applicable in every sphere: managing time, balancing priorities, and interacting with people. I began noticing how frequently I compromised principles under the guise of short-term gain or fear avoidance. The pattern was the same: deviation from a plan, temporary relief, long-term cost. Trading had become a mirror, reflecting my tendencies, weaknesses, and areas for growth. With each trade I reflected on, I started to notice something profound. The market wasn't the adversary I had imagined. It wasn't a cunning opponent trying to trick me. The real battle had always been internal. The swings, the spikes, the gaps, they were neutral. It was my interpretation, my emotional response, my willingness to override my rules that turned neutral events into crises. Once I grasped this, I realized that I could shift the focus entirely from beating the market to beating myself, not in a competitive, punishing way, but in a disciplined, constructive way. I implemented another layer of protection: pre-trade mental rehearsals. Before taking a position, I would visualize the trade from start to finish. I imagined the ideal entry, the stop-loss triggering, and how I would respond if the trade went against me. I pictured myself holding the trade without interference, acknowledging discomfort but letting my plan guide my actions. These mental rehearsals weren't vague affirmations, they were highly detailed, almost cinematic simulations of real market scenarios. Surprisingly, this practice trained my reflexes. When real trades unfolded similarly, my responses felt almost automatic. I wasn't cold or emotionless, I was prepared. An interesting pattern emerged in these exercises. I realized that the intensity of emotional responses often had less to do with the actual trade and more with my expectations. When I clung to a desired outcome, when I needed the trade to validate me or prove my skill, my reactions intensified. Fear became sharper, impatience grew, and hesitation lingered. But when I detached from the outcome and focused solely on execution following the rules I had laid out, emotions became manageable. Losses were data, wins were feedback, and every trade became a lesson rather than a verdict. One particular episode stands out vividly. I had set up a trade I believed was perfect according to my system. The market moved against me immediately. My chest tightened, my mind raced, and the urge to close the trade prematurely surged. Usually, this is where I would panic. But that day, I remembered the mental rehearsal. Observe the feeling. Notice it, don't obey it. Follow the plan. I took a slow breath, reaffirmed the stop loss, and let the trade play out. Within minutes, the market reversed, hitting my target. The difference wasn't the market, it was me. The small pause, the conscious recognition of emotion, had allowed me to act in alignment with my plan. That trade became a turning point, not in my profit, but in my confidence. I also began tracking not only trades but environmental factors. Time of day, sleep quality, diet, interruptions, and stress levels, all of these subtly influenced my behavior. On days when I was rushed or fatigued, my impulse to override rules increased. When I ate poorly or skipped breaks, my attention span shortened, and decision making suffered. This was This wasn't a matter of superstition, it was a recognition that human performance is contingent on a network of physiological and psychological variables. By tracking and managing these factors, I could create optimal conditions for disciplined trading. The next evolution was handling repeated mistakes. Even after journaling and awareness, I sometimes fell into old habits, chasing trades, moving stops, or overleveraging. Rather than chastising myself, I began to analyze the triggers. What had I ignored in the moment? Which emotions had dominated my reasoning? I created a pattern library of my recurring mistakes, complete with interventions. For example, when frustration after a loss triggered revenge trading, my intervention became stepping away from the desk for 5 minutes, breathing deeply, and asking, "Is this trade part of my plan, or my frustration?" By institutionalizing these interrupts, I neutralized the power of impulsive reactions. I also discovered the subtle power of micro-affirmations during trading. While trading live, I would remind myself, "Follow the rules. Accept discomfort. Trust the process." At first, it felt redundant or even silly, but repetition turned them into mental cues that guided my actions. Each affirmation reinforced my emerging identity, a disciplined trader capable of managing emotion and uncertainty. The mind craves consistency, and these statements became the scaffolding upon which my trading behavior rebuilt itself. Another dimension emerged when I began reflecting on the bigger picture. Trading was no longer just about immediate gains or losses. Each trade became a microcosm of my behavior, a chance to practice patience, discipline, and emotional intelligence. I realized that success in trading wasn't a single outcome, it was the accumulation of thousands of micro decisions executed in alignment with a well-defined plan. Each correctly executed stop loss, each avoidance of impulsive action, each pause to reflect became a victory in itself. Over time, these small victories compounded, creating a mental and emotional edge that no market fluctuation could disrupt. Through these experiences, I noticed how often traders, including myself initially, confused luck with skill. Early wins reinforced overconfidence, early losses reinforced fear. Without a structured approach to psychological training, the mind invents stories to justify behavior, often at the expense of the account. By focusing on process over outcome, I shifted the metric of success. It was no longer about individual trades, but about the quality and consistency of my decisions. This mental shift transformed trading from a roller coaster of emotions to a controlled, deliberate practice. As I progressed, one insight became unmistakably clear: the market doesn't punish mistakes, it amplifies existing patterns of behavior. If I consistently reacted emotionally, the market merely reflected that. If I consistently followed rules, the market offered opportunities without interference from my own mind. This realization changed the way I approached every trade. I wasn't looking for the perfect setup anymore. I was looking to test myself, to observe how well I could execute under pressure, how I could maintain discipline when discomfort was high, and how quickly I could reset after setbacks. I developed what I now call the emotional calibration process. Before each session, I would assess my internal state. Am I impatient today? Am I frustrated, tired, or distracted? If the answer was yes, I would take steps to correct the imbalance, whether a short walk, deep breathing, or simply delaying the session until I could approach it with clarity. During trading, I monitored my responses continuously. Each spike of fear or surge of excitement became a data point. Rather than judging it, I labeled it. This is impatience. This is doubt. This is overconfidence. Naming the emotion in real time diminished its power. Awareness became the bridge between reaction and deliberate action. The journaling process evolved alongside this. I stopped logging just outcomes. I began logging the context and my thought process. For example, after a trade, I would record not only whether it hit the stop loss or take profit, but also what I felt before, during, and after execution. What mental shortcuts had I fallen into? What distractions were present? What narrative was my mind telling me about success or failure? This granular analysis revealed recurring themes and allowed me to design targeted interventions. Slowly, patterns of impulsivity, procrastination, and self-sabotage became visible, measurable, and manageable. One particularly challenging period illustrated the importance of this process. A series of trades moved against me early in the week. Normally, this would trigger frustration and revenge trading, adding positions I shouldn't, moving stops, and seeking to recover losses immediately. But I recognized the early warning signs: irritation in my thoughts, tension in my chest, and a desire to fix the losses. Following my process, I paused, stepped away from the screen, and reminded myself: execution is more important than outcome. This is data, not a verdict. When I returned, I executed my plan precisely. The trades didn't always win, but I avoided catastrophic errors. The focus on mental calibration, real-time awareness, and adherence to process had prevented a minor losing streak from becoming a disaster. I also learned the subtle power of trading rituals. Small routines starting with reviewing prior trades, confirming the day's plan, setting alerts for stress or fatigue, and even physical cues like adjusting posture or stretching created a rhythm. This rhythm became a mental anchor. It wasn't superstition, it was engineering the environment to support optimal decision making. Over time, these rituals reinforced discipline, consistency, and emotional resilience. My mind began associating these physical and mental cues with focused, process-driven trading behavior. Perhaps the most profound shift came in recognizing the link between patience in life and patience in trading. When I practiced patience outside the markets, waiting calmly for family routines, tolerating delays, listening fully before responding in conversations, I noticed a remarkable correlation in my trades. I could hold positions longer, wait for the precise setups defined by my strategy, and resist the urge to overreact. Trading became a reflection of life habits. The more disciplined and patient I was in everyday actions, the stronger my trading discipline became. This insight highlighted that trading psychology isn't isolated, it's a mirror of personal habits, self-awareness, and emotional intelligence. I also explored the role of recovery and reflection. After every session, I dedicated time to decompress, reflect, and learn without judgment. Even on losing days, I would write down at least one micro success, adherence to a rule, recognition of an emotional trigger, or a pause that prevented a poor decision. These micro successes built confidence incrementally. Over months, I realized that these small wins, mental, emotional, and procedural, were far more valuable than any single profitable trade. They compounded into a resilient mindset capable of navigating the inevitable ups and downs of the markets. By this stage, the cumulative effect of awareness, journaling, rituals, and patience reshaped not only my trading results but also my relationship with the markets. The charts no longer dictated my emotions. News events no longer triggered panic. Losses became neutral, wins became feedback, and every trade became a structured opportunity to practice discipline. I understood that I couldn't control outcomes, but I could control my behavior, and in trading, behavior is the edge. In essence, these case studies revealed a core truth: trading success is inseparable from self-mastery. The hardest lessons, the moments when I struggled to stick to my stop-loss, the periods when revenge trading tempted me to abandon discipline, were also the most instructive. They highlighted gaps in mindset, emotional control, and identity. By systematically addressing these gaps, tracking behavior, and reinforcing process over outcome, I gradually transformed from an impulsive trader to a disciplined practitioner. Each trade became not just a financial decision, but an opportunity to strengthen self-awareness, patience, and resilience. The journey through these case studies is ongoing. Markets will always present challenges, and emotions will continue to arise. The key isn't eliminating difficulty, it's cultivating the tools to respond thoughtfully, execute consistently, and recover swiftly. Through continuous practice, structured reflection, and deliberate habits, I turned the mistakes that once threatened my account into lessons that built an unshakable foundation. The transformation wasn't immediate, but over time, the alignment between mindset and execution became the single most reliable source of edge in my trading.